Hi, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update for the month of June. What we're actually going to do in this update is I'm going to bring you up to date for the quarter. We're going to talk about what's going on with interest rates. What have they done so far this quarter? What have they done year to date? We'll take a look over the last 12 months. We'll also take a look at what the markets have done in the second quarter. And we're going to talk a little bit about precious metals, consumer confidence, and the PMI. So a lot of data that we're going to cover today, and I'm going to try to do it in a short period of time and keep it as high level as possible so that you can understand what I'm talking about. All right, let's start with the yield spread between the 10-year and the 3-month Treasury. We talked all the way back in April how the 10-year Treasury and the 3-month Treasury inverted in the month of March. And so this chart will actually show that. So right here, you see the blue line dropping below the orange line. And that means that the orange line, which is the 3-month Treasury rate, was actually yielding more for a little period of time there than the 10-year Treasury was. That was our first sign that says, oh my gosh, every time this has happened since 1950, there's been a recession follow within the next 5 to 24 months. Well, that inversion ended a short time after that, but as you'll see here in May, that inversion happened again, and today we're sitting at about the widest yield spread that we've seen. We had a little bit higher yield spread back here in early June, and so what this is showing you down here on the bottom is this zero line across here is showing you when did the 3-month Treasury start yielding higher than the 10-year Treasury, and so we've seen that spread increase to where we're now at 21 basis points, where the 3-year Treasury, or 3-month Treasury, is yielding higher than the 10-year Treasury. Once again, it doesn't mean that there's going to be a recession tomorrow. There's no guarantee that there is a recession coming. However, since 1950, every time that this inversion has occurred, there has been a recession follow within the next 5 to 24 months. So we definitely have our eye on that. Let's take a quick look at the stock market for the second quarter. If we look at the stock market for the second quarter, what you see, April was a good month. May took all that away and then some, and then June basically got back most of what May took away. So we wind up the quarter not really great. I mean, there's a couple of percent there on the S&P 500 and the NASDAQ, Dow Jones Industrial Average, up about 1.3%. So we did have a nice recovery in the month of June, brought back most of May's losses from the markets. I will tell you that we're here on the 9th of July as I record this. I had a little bit of a vacation there for the 4th of July holiday, so I apologize for being a few days late on this. But that actually is showing us that now in July, a little bit of what we got in June has been taken away again. If I look at what most of the big banks, big brokerage firms are forecasting, slower growth is definitely ahead, although most of them are still pretty bullish on U.S. equities. Let's take a look at what's going on with consumer confidence and the Purchasing Managers Index, the PMI, the orange line here. So you can see in May and in June, we continued to see that Purchasing Managers Index continue to fall, and that is really a sign of what is industrial production. And so what we're seeing is a decline in that, and that is showing us a slowing trend in the economy, which really coincides with what we're looking at on that inversion between the 3-month Treasury and the 10-year Treasury. We also saw consumer confidence start to dip here, and I just laid the S&P 500 chart over the top of that, and just kind of see that there really doesn't seem to be any correlation between what the stock market's doing and what's happening with the PMI, and that is even greater exacerbated here in this 1-year chart. So you see the stock market was really kind of following along with the PMI. Now the PMI has continued to decline since January, and yet the stock market has taken off like a rocket ship. So I did a similar chart to this back earlier in the year, where we're seeing stock prices rise, yet we're seeing economic indicators telling us that things are slowing down. So one of two things has to happen. We either have to get the economic indicators and the economic activity to come up and meet what the markets are doing, or the markets will come back down to meet what the economy is doing. Again, nobody has a crystal ball. We don't know exactly what's going to happen, but we know this divergence that we're seeing here isn't something that is normal, and it's something that we have to pay very, very close attention to. One last thing here as we wrap up this video, I want to talk to you a little bit about what I'll call the fear assets, the assets that do well in times of economic fear or market fear, and that is precious metals. So as you can see here in the month of May and June, and even a little bit into July, gold prices and silver prices have started to increase quite a bit. The only thing that really hasn't gone up is the copper, but this increase in gold and silver prices that we've seen here over the last couple of months is really indicative of that consumer confidence falling. It's the PMI, it's the fear of an economic recession coming somewhere down the pike. Again, none of these things occur on a calendar. Nobody tells us exactly when they're going to occur. What I want to try to do is just bring you the information, let you know that we're on top of it, we're paying attention to it, and as we design your portfolios, this is what we're looking at. We understand that most of our clients are like you. They're either already retired or they're going to retire in the next few years. We've built your financial plan to a point where we think your asset allocation is the way that it needs to be, and as I do every single month, I want to encourage you. Keep the dialogue open with your financial advisor. Talk to them about your current asset allocation. Talk to them about what we're talking about on today's video. Make sure that you understand what we're doing, why we're doing what we're doing, and how it fits into your overall financial plan. So with that, I hope you're having a wonderful summer, and I'll talk to you in just about 3 weeks.